we'll go ahead and get this started. So for everyone that's on, thank you. If you end up watching this as a recording later, we will send it out. Feel free to email or give me a call with any questions. We will do Q&A. We'll monitor it throughout. Certain ones we'll do a full Q&A at the end. But if certain ones pop up and the team sees them, we may just answer them as we go if it's pertinent to a certain slide or topic we're on. So thanks everyone for joining us. I'm Brian Ferguson, managing partner, Fergmar Capital. Along here on the call with us is Bailey Koopman. She is our director of asset management, oversees everything asset as well as property management. And Clayton Garner. Clayton does all of our underwriting, diving into a lot of the data, the details in the market. So they'll both be here with us today, and you'll hear a little bit from them. If you joined us before, we started this, last quarter, we started off doing a Q1 webinar. We want to keep these going every quarter, just tell you a little bit about what we have going on, what we're seeing in the markets from our point of view, and some update on some of the deals, et cetera. So that's what we'll go through today. We'll talk a little bit about interest rates, kind of what we're seeing supply and demand, and some of the market trends we've been seeing. All right. So kind of introduce us a little bit. So we're a Texas-based real estate investment firm, for those of y'all that don't know us. Our focus right now is multifamily and commercial, specifically kind of retail professional centers is what we've been focused on more heavily. We're Victoria-based. That's our corporate office is, and then a few years ago, we transitioned into some other markets, some Houston submarkets, just really focusing on markets that meet the data points and some other buybacks terms for us. But really, we look at communities as well. We like to expand inside of a community instead of just buying assets all over the place. We're really built on, we'll talk about this a little bit more, and a lot of you may know this, we're operational. So when we talk value add, we're very big into getting into the operations. How can we fix things at an operational level, not just paint the walls and raise the rents? So we are actively trying to grow throughout Texas. So little quote there to the left, our focus isn't on doing more deals, it's on doing the right deals. I've had tons of calls and people that are looking to deploy capital, want to know when the next deal is, why we haven't brought one out. We are actively looking at deals and for the right deals, but as many of you know, follow us, we just acquired two, and so we'll put more of our focus on getting those where they need to be before we buy more. So, this is just where our portfolio sits today. We're currently 137 million assets under management. Of that, about 90 is our corporate portfolio up to 2022 before we took outside capital. And the difference is what we've grown since. We're sitting about 1,000 plus multifamily doors. We're in that 1,200-1,300 range, somewhere around there. We have about 500,000 square foot of gross living square footage on commercial. So that is, again, those are retail professional centers, and then all the doors are the multifamily count. Right now, we currently have 157 active investors, equity under management, 17,164,000, and distributed 1.3 million to date. Kind of important to know there, since we just very into 22 is the first time we took outside capital, so we haven't had any full exits. So those are just from quarterly distributions. One really successful refi, but no exits yet. Those will start coming probably beginning of 27. We're going to start prepping for a few of those 22 assets. This is just kind of about where we sit today. We're Victoria, Texas. We're still looking at stuff here if it comes, but we are pretty saturated in this market, so I don't know if we'll have more here. And then we're in Katy and Sugar Land. We expanded those footprints. We're actively looking in those markets and a few others. We'll get into that a little bit more. From Q1, kind of, we mentioned this in the Q1 webinar, but a continuation of it. We closed two major acquisitions, the Grove 288 unit multifamily, and then a 36,000 square foot retail professional center in Sugar Land. So that expanded our Houston kind of submarket footprint with our second large purchase there. A few other notes that happened throughout this quarter. We've got over 40 units turned at the post this quarter, about $125 our average rent increase there. So that's been really well. The Grove transformation has been full steam ahead. We're ahead of schedule on so many things, and we'll talk about that more. And then we've 157. So the active investors, we surpassed the 17 million mark and hit the 1.3 million in distribution. So it's pretty good milestones for us this quarter. We'll get into some deal specific. So just let Bailey get to the details here in a second, but for those who don't know, we closed back in March on the Grove. Um, it was being poorly from an operational standpoint. It had a bunch of construction done, a lot of things during due diligence we unwound. For instance, they had fresh painted it after they bought it in 22, but you'll see like in one of these pictures here, if you see all the lines on the building, they're doing something called tuck pointing. Just, there was brick that they painted that was literally going to fall off. So down to new roofs and a lot of amenities happening. So there's been a ton going on there from a lot of construction and then also a ton on the operational side, just really getting rid of all the non-payers or, the tenants that are leaving trash everywhere and just a lot of day-to-day happening there. But it's been a very heavy lift. And it's a tough one to juggle because, if I drive by there and I see all the construction happening, that's an exciting day. But is that an exciting day for the tenants when there's stuff going on everywhere, So plus, a lot of these tenants have been there a while and they've been through multiple owners that didn't do what they said they're going to do. So it's just been a lot of building relationships there. But Bailey, you want to kind of jump in, kind of tell us from the operational piece and construction? And I know it's a lot going on.
Yeah, this quarter we've definitely had the Grove, which has been one of our biggest lifts to date. We have our hands wrapped all the way around it. I mean, exterior paint is nearly completed across the entire property. That's all carpentry and framing as well. We have roofs on zones 1 through 2 or 1 and 2. We've broken up the property by zones just to ensure that the construction is moving in the most efficient and effective manner for the residents to limit disruption as we do try to retain, the people that are paying and want to be at the property. So roofs are on buildings 1 through 8. Flat work completed across multiple zones, staircases, landing rebuilds throughout the entire community. That's almost completed. Pool repairs were completed close to the beginning of Q1, but into Q2. So the pool was reopened for residents for the summer. We have an HVAC repair and replacement program with the on-site property management team, just really focusing in on resident needs and work orders. And then this quarter, we will begin our full dog park amenity addition along with the gym expansion as well. For interior renovations, we have over 20 units under active construction. That is for a full interior remodel and does not include about the 5 to 6 units that the property management team is pushing out a week just to support leasing retention. And then I think the biggest change, like you said, is probably operational. We have 70 residents paying on the online portal. We have management team just fully focused on rebranding, community retention, just because of the feedback across the asset before our purchase. We have preferred employee programs, underwriting Victoria. We're strengthening kind of the resident pipeline there, and then weekly reporting and weekly calls with the property management team with weekly site visits from the asset level as well. So we have our hands, fully wrapped around it. It's definitely been one of the biggest heavy lifts so far, but it is rewarding.
And one thing to add there, the Grove was our first third-party management for multifamily and our first third-party management in Victoria. We do use third-party management in our assets in the kind of Houston submarkets, Katy and Sugar Land, but nothing here. So we partner with the group, Capstone Management, and it's been phenomenal. We're on a call every week. We're on site multiple times a week. Bailey's on site all the time. And what we've really seen is, certain pieces of expertise they bring by, being one of the largest property management firms and, 40, 50,000 doors. But then also in those same calls, hearing our team, Bailey specifically, or feedback that we give them, even though they've been doing this since the 1960s, we're still able to use our 20 years of experience and things that we've done differently. And between their economies of scale, their experience, and then our specific pieces, because we're kind of a think outside the box when it comes to operations. But adding that all in together, we've really seen some momentum there. So we're very pleased with that relationship and expanding that daily. So, okay, jumping on next project, the Post on Sam Houston. We threw this one in here. This was a purchase back in right at the end of August of 25, but it's still something we're still in that stabilization and finishing up construction. So we just wanted to do an update here. But this was 104 units. Again, this is one we closed, did a loan assumption. Seller was in a default, so we kind of came into a pre-foreclosure. It was in default due to just not creating doing the repairs, the lender required repairs. So we assumed the loan as well as assuming his issues with that. We've worked through that and been pretty successful. But Bailey, if you want to jump in and kind of give a quick update on this one as well.
Yeah, so main focus here really is just kind of fine tuning some of those operational improvements as we're moving closer to the end of the stabilization plan. We did bring on or decided to bring on a new painter just to wrap up the rest of the progress, but all exterior property work is pretty much finalized other than what we're working on, right now to wrap that up. Focus is definitely shifting to more of amenity features that we've added along the project, just really focusing in on, tenant surveys, tenant feedback. What are they looking for? What do they want? Here we've been able to retain quite a bit of the tenants, and this is one of our first projects that we've done an all bills paid model, which has been extremely successful with pairing with like Texas A&M University here in Victoria, local preferred employers like Caterpillar. So we've seen a lot of success with kind of the operational model that we provided at this property with the all bills paid, which does include Wi-Fi and cable, an extra feature that a lot of the assets in Victoria do not add. Renovation is continuing under progress, like I had discussed in you as well, with interior work happening. We've been lucky enough to pre-fill ahead of turnover to kind of support the on-the-ground leasing efforts. We have an amazing property manager on site. Each week she's pushing out 3 to 4 leases, so we've seen a lot of positive, kind of feedback in the community come from that. Just focusing really on wrapping up construction and kind of stepping away and letting the property management team do their thing.
She said lucky, but it's crazy how luck happens when they work really, really hard every day,
Yeah,
and the results fall into place. So, but yeah. Um, and then one last update here, Grand Parkway. This was closed back in March as well. This was a 36,000 square foot. It's like a retail professional center that we closed on almost a week apart from the Grove. It wasn't scheduled that way. It's just what happened. Um, this one, we just started. We waited a little bit on construction there. There were some other pieces we were working through, and but we just kicked off construction there, and they didn't give some detailed updates. But they're moving extremely quick. This is another. We use the property management team to handle. We it's another really good the partnership. The property management team was managing the construction, but at the same time, we're the ones we did a lot of the vetting of the contractors. One of our partners drove down there, vetted them, went through the bids. Bailey went over everything, looking at different selections, but then they're managing it. And so just seeing their experience with our collaboration and how phenomenal it works, it's just really great to see that, because as our expansion continues, these partnerships with other great companies, whether it be management, construction, is going to be huge. So one thing before Bailey gets into it, we are going to actually host a tour here. We want to get through most of the construction, but we're targeting August 20th. You'll see some more communication on that, but if you want to tentatively put that on there for anybody that thinks they want to make it, we're going to be doing probably around a 4 p.m. We'll tour the property, about an hour or so, maybe less. We'll break, and then we're working on finalizing the venue where we'll have a happy hour afterwards. We get together, maybe a few drinks, a few appetizers, what have you. So for people that want to come in, and we'll also be inviting local people in the community as well. So Bailey, you want to give us a quick update on what's going on
yeah.
there?
I mean, even as we worked through, kind of identifying some of the operational improvements that we could make before we started construction in the first quarter of the year, closing at the end of that quarter, we've been making extreme progress. So construction is almost completed. The repositioning is kind of near the finish line. We have paint samples up, with paint happening within the next 3 weeks. Awnings are under production, and then we've done our completion on full striping, pressure washing. New signage of the property is being built. Tile removal has been completed across all 4 buildings. Some masonry, like brickwork repair, stonework as well, flatwork repair across the property. And then another large upgrade was the property lights, going to all LED, just getting a full kind of uniform, clean look. To really push leasing. We do have all vacant suites currently in progress of being white boxed as well, just to kind of support those leasing efforts. And we have pretty strong initial traffic. with our one of our first LOIs coming in actually this week. So we've had multiple active leads for the business interested in the property, doing tours. Signage is up, and we're really excited about that. It's posted on all platforms as well. Some of the operational improvements that we've made is really just keeping like the reposition strategy on track. Kind of combining some of those leasing efforts with the physical updates that I talked about, and then just direct hands-on oversight, which you did touch. While we do, trust and support the property management team to, oversee the project and the construction, we are very hands-on ownership-wise. So we've vetted all bids, vetted the budget. We're checking in, checked in on the samples in person, drove down there. So we like to keep our hands, around the asset, even if we're not exactly local, even as we expand. So.
Absolutely. This is just a great example. Phenomenal location, kind of off of 99, right off of 59 there. It was a great location, just a very tired center, from paint peeling, just faded awnings, vacancies that have been sitting for years, multiple different numbers based on what sign you drove by or on the window, just different numbers from different management teams. It's our approach, completely updating the outside. And then even on these interiors, we'll white box them, clean them. I mean, they've been vacant for 3 years and still had trash in them. So just clearing all that out. We invest the money to get them white box. A lot of people take the approach, well, if I'm giving you TI dollars, you can figure that out. But even someone opening their 50th location or 10th location, sometimes it's hard to see when there's just trash and it stinks or what have you. So it's a great example of it was a tired center. It needed new life and new ownership. And so we're really excited for this one. And again, August 20th, mark your calendars. We'll send out more information on that. But if you want to come tour the property, come to a happy hour, come to one, come to both, what have you, we'll be really excited to see some folks there. Okay, we'll get into the current pipeline. So these next few slides, let Clayton jump in here and talk about kind of what we've been looking at, and then we're getting some deal specifics and kind of what we're seeing in the markets. Clayton, if you want to take it away.
Sure. Yeah. So during the last quarter, and we kind of touched about this during, I think, the last quarterly webinar as well, I've seen a lot of growth in the number of deals coming through and actually being submitted. And we have a pretty thorough process when it comes into actually vetting each deal. Some of them are instantly disqualified based on location. We've already determined we don't like, but for the most part, everything gets some kind of, look back and diving into. And there's quite a few that we've actually dug into pretty heavily that look like they could have been deals. And then at the end of the day, we just got down to the wrong numbers and couldn't make it work. So as you can see there, 130 total opportunities tracked. That's this year so far. Quite a bit of those reviewed in the last, I want to say, quarter or so. You can see 27 opportunities. 21 of those are already declined. They're not there anymore. So we've got, the 6 pending that are, in different phases of evaluation right now. But that's quite a lot on the table if you compare that to, this time last year where we were getting, 1 or 2 a month. So a lot of stuff hitting the market right now. I think it's increased dramatically across, most parts of the state, especially the coastal areas and that in part tying into Houston. So.
Yeah, and then, we have multifamily retail. We've looked at some medical office as well. At least that's what they have it labeled as. Some people send us, we try to say complete no to it because we are kind of retail professionals. So if we can make it fit in there, we're looking at that. We spent a lot of time on broker relationships, getting a lot like from social media, different platforms, people reaching out and sending us stuff. So we'll send them the buy box. Our team's been, sourcing off market. Clayton's put in a lot of different tools with AI, and probably talk on that here in a little bit on how we're getting through them. But yeah, the deal flow is definitely, and I would say of those 130, those are opportunities that made it far enough for us to even get reviewed. But there's probably another, I don't know, probably another couple hundred that never make it past the email inbox. So we're now scrubbing those, and they have to at least meet the initial level. So the 130 met some type of level of our buy box, and then then they were disqualified down to the 27. So a little bit of what we're seeing there. We've seen increased deal flow. We talked about that. More opportunities for us to underwrite, so that's been great. And some of these deals, honestly, if 2 years ago, there's multiple deals that they probably penciled as good as deals we have in our portfolio, and we would have said yes to. We're being a little pickier right now, and someone asked me today, you think that's going to come back and bite you? Are you going to miss out on a deal? Maybe, but we want the deals that have a ton of upside. And that's going to mean it's going to be a heavier lift. It's going to mean, Bailey's spending more time on site there. Our team, it's going to be more construction, more operational issues. We know that the bigger deals come with more issues, but we have the team and the experience and the know how to do that to deliver better returns. And so that's what we're looking for. We're looking for the ones that there's some type of opportunity built into it. So, but yeah, we're seeing more attractive opportunities, coming from some of the refinance pressure or expiring loans, and that's given us more leverage and, buyer negotiations and whatnot. So, been very busy there. And now we're gonna get to some deal specifics, and we'll go through this, what's on the screen. Clayton probably has some other data. We're going to go through one multifamily. This 288 units is just a coincidence, has nothing to do with our 288 unit deal that we purchased back in March. But we'll get into this one, and then we'll get into one professional retail as well. So Clayton, take it away.
Yeah, so as I mentioned, there were quite a few that got all the way down to the very end of our underwriting process, and then they just kind of didn't work out. So we've got 2 of the 4 that kind of got there in the last quarter, and I just want to talk a little bit so people have a context of what we're looking for. So this property specifically is an apartment complex located on Westheimer in Houston. It's actually situated in an area where there are, countless apartment complexes directly related next door to it. They're all different owners, different entities, but everywhere you look, there's an apartment complex. The good thing there is you have a good baseline of looking for what market rates can be, what your unit types can look like. If you're going to remodel, do heavy capex, what you're trying to shoot for. So in this case, everything checked out at first, and when we started looking at the actual remodel cost per unit to bring them up to what the comparable properties were, we kind of saw a pretty straight line trend where the units they had on site that were already turned were not driving quite enough value there to even justify the cost of remodel. And then when you compare that to the fact that the units next door are, maybe slightly nicer but renting at a lower rate, it doesn't give you a lot of room for error. And obviously, when you're underwriting something, we want to have safety nets in just about every phase of the project we can, just in case something were to go wrong. And when you get down to the bottom of it, it was just we had no way to make the rental growth work, and by comparison. And normally we would maybe look a little bit tighter at that, given our market expertise in Victoria, but given the market, being right in the heart of Houston and Westheimer, you've got all these operators around you, and you're not really playing a marketing game at that point. You're playing a who can show the prettiest picture. Just because you want to live in that area, you're going to pick one of the complexes, and the money is going to drive the end-all decision. So it kind of came down to just not making enough money on the construction to justify higher rents and actually feel like we can get those rents. Even though the units were attractive, they were larger units. They had better layouts and everything. It still wasn't enough of a driver to make the deal work.
Yeah, and one important takeaway there that we've really realized is, you get the broker OMs, and we may have a few brokers on this call. I think I saw a few sign up, but like we appreciate the broker OMs. There's a ton of data in there, but that is not our end all be all. It's a starting point, and it is great to have them because when you start evaluating something that has off market, there's some data in there, but you have to validate the data because they may use a comp that's extremely similar and they are achieving the extra $150 a door. So then they put a whole business plan on, oh, okay, well, there's 200 units. If you put 5,000 a unit, you're going to achieve the $150, $175 a door. But to Clayton's point, okay, back into that, look at the ones that have already been turned and did they do a good job on it? And if they're not achieving that now, now we go down another vein there. Is it because it's just, poor advertising? So we'll dig in there. But if they have them advertised, we're seeing them on all the platforms, they've been remodeled. Sometimes it's hard to think, oh, you're 2 blocks away. Why can't they achieve the same thing, the same square footage? But if they're not, they're not. So not saying we won't go in and go, okay, we can do something they didn't do. We obviously will, but if it's all dependent on that happening and the deal falls apart without it, it's gonna be a pass for us. So I think a lot of people have learned that lesson recently. So, and now we'll get into a retail deal. Go for it, Clayton.
Yeah, I think I kind of slightly mentioned this last quarter as well. We were actively underwriting at this point. There's quite a few areas, along the Katy Freeway, and as you're going out to, Full Shear right now, that are just in a mode of hyper expansion. There's stuff everywhere. There's subdivisions going up everywhere. They're all master planned, and what we're seeing is a lot of the centers that were built, 5 to 6 years ago during the last phase of hyper expansion before COVID hit. Those centers were all signed up with 10-year leases. So they have these tenants in there, and they were signed on 10-year leases that were based around a new building being in a very, hot and prominent area. So they were running, top of the market at the time. Well, because the area has grown so much, they're no longer in the new area. So you have these tenants that still have 5 years left in their lease, but their lease rate may be, $3 or $4 higher a square foot than, what a comparable center may be that's trying to lease today. So sure, the numbers may look great on paper based on who's currently occupying it, but when you factor in that you're going to have to be the one to deal with those people leaving and releasing it, and there's no feasibility that that center is still going to be the up and coming center or the area, it really makes you look at, you know, heavily at what the vacancies are in the area and why aren't they leasing and what are they leasing at. And we've seen some pretty heavy centers. This one's a little smaller, 6.9 mil ask, but I've seen, some 20 and 30 unit centers that are mostly full now, but they have long-term leases in place, but then they have vacancies that haven't been filled in 2 to 3 years. So they're just because the numbers work today doesn't mean they work when you actually start looking at the area, feasibility long term. And just one thing we're really being cautious about is all those hyper, anywhere you can, look on Google Maps and see nothing but construction around it in circles is not usually a good sign for the retail stuff unless it's priced based on what the market's going to end up being, sometime in the future. So
Yeah, another big deal we're seeing in a lot of these where they included some type of build out. We've done the same thing. You can go through some of our centers and, market rates, $30 and you have this one outlier at $38 a foot, or it's $22 at market and they're at $28 a foot. Well, will be presented this as a value add, like, hey, look, these guys are $28 a foot. These other people are at 22, up on renewal, you can get them there. But the honest answer is if market really is that 22 to 24, what's going to happen is when those $28 people renew it, unless they have some predetermined, options in there. But a lot of times if they do not, they were paying that build out for that first 5 or 10 years, and they don't intend on paying, if they don't need another build out, they're not going to pay that. And if someone new comes in and needs a different build out, not only are you not going to achieve the 28, you're going to drop back to say the $24. You're also going to need to come out of pocket more TI dollars. So that can be a very risky piece and it's pitched in a lot of decks that come to us. So, okay. Just kind of some overview of kind of the Victoria market for if you haven't been on here or haven't seen any of our information on it, but we've got stable employment, healthcare, education, industry. Amazon opened up a big facility just due to our proximity to other towns. Texas A&M had taken over. That happened. It's been a while now, but that's drove a ton of traffic there. So we still could see, there's no multifamily supply. Maybe people building a few duplexes, if that. But so limited to no new supply. The workforce housing demand continues to be there, and then occupancy has remained resilient despite the higher interest rates, and that could sometimes even driving that. But we're everything's been staying on track there. The takeaway here is just the supply remains constrained while long-term demand drivers are still there. No new supply is coming in, so we're able to see consistent, healthy increases as renewals come. And then this is just what we're seeing in the Houston MSA. Obviously, that's a massive market, but this is just what our take's been. New supply, the new supply is, there was a ton of them started when everything was hot and heavy. That has slowed down, and we're seeing that. The leasing activity across the ones that we're looking at in the submarkets, we are still seeing, nice renewals in those areas, and that ties directly to not having as much new supply there, and so not having that, much concessions. We're seeing more transaction activity. Just it's either, someone's expiring, they need to sell, or people feel the market's better, so they're ready to sell, just different factors. And then just better acquisition opportunities. As people are adjusting their expectations, maybe I'm not going to get the price again, maybe I need to sell, whatever that is. So, but with disciplined underwriting and the market knowledge, which is where we're heavily focused, we definitely think the rewards will be there. We're just going to stay disciplined and keep looking and finding the right deal. So the markets we're looking at, as Clayton mentioned, Katy, Fulshire, we look at stuff from Brookshire, Dickinson, just greater Houston. We're looking for, population trends, employment growth. We're watching the new supply, the lease rollovers, concessions, and then debt and refinancing pressure to the point we have some sources where we're pulling, loans that are expiring. What we look at if it's on a foreclosure list, but then also ones that are expiring and when they had it, and we kind of run that through our system. And okay, if they bought at this, rates were probably 4%, 3.5%. if we don't have that data in front of us, and then what's it going to look like. And a lot of times, even if property's performing well, they'll let it go at a good price if, if they're going to lose cash flow. And we have some of our properties, we're looking at the same thing just due to the refi. So Clayton, anything you want to add there on just different markets we're looking at and data points we're looking at?
Yeah, I mean, we look quite a bit at, when you get to the east side of Houston, all the stuff along the coastal corridor right now is extremely hot. Like there's tons of listings. I mean, we're talking, multiple deals a week of listings coming out. And, we got to digging on, the market data for that area, and all the stuff pretty much in Brazoria County or right around that, it has really decent pricing. But we've just noticed that the trending numbers on rental growth are just they're really bad. In most cases, they're pretty negative. So we're, here in Victoria, we're running, 11, sub 11% loss rates, by the time you take out, concessions and, bad debt and vacancy, you're talking about numbers in the 20s here, and that trend is going downward. So there's going to be opportunity there. It's just not today. So it's something that we're seeing tons of marketing stuff come on, and we're cutting back on, like Brian said, we were at a point at the beginning of the year where we would take any deal in and look at it. It doesn't matter where it was. And we've really gotten that narrowed down to looking and disqualifying areas so we can focus on the areas that do have the expansion. So, yeah, I mean, that's pretty much all I think I would say there.
Yeah, and I mean, just I've told, if you've been on a call with me, I bring this up a lot. Like one thing we used to look at retail was traffic count, traffic count, traffic count. And then we went in and we got on calls with leasing brokers, and you figure, okay, if we want to know what these national tenants are coming from, who's bringing them to us, okay, they're coming from these leasing brokers. So we got on a call with, I don't know how many calls we had when we were going through this research phase, but little things like, okay, there can be 150,000, traffic count, or 70, whatever the traffic count is. But if the traffic count coming by does not have your median household income that a national tenant's going to look for in that area, it doesn't matter. Meaning, a Lululemon's not going to put in a store if the 100,000 people a day driving by can't afford to buy their product. So just a lot of little data points, and we're constantly, feels like we're always adding them. It's like that's another thing that we're looking for that can disqualify it. So sometimes it can be discouraging, but it just goes back to that discipline and making sure we're looking at the right deals. Kind of a little bit of the market environment and where it's at and what's changed. I've spent a ton of time looking at term sheets on refinances, and not necessarily, like even stuff from 22 where, that we bought, we're looking at, okay, it's next year, but let's get ahead of it. Hasn't been the right time. But then we have some of our initial, like kind of corporate portfolio outside capital, that tons of that, some's expired, even to the stuff, we have stuff that, smaller deals that we've had that, it doesn't even make sense. That there's a rate out there at, say, 6%, but you look at, and you're currently paying 7 or 8, but if it's a really small balance deal on it and you don't really want to pull the cash out, well, the fees could offset that. So just been looking at a lot of that, and certain rates are better. For instance, we did, our Grove deal had a rate cap on it, but it is a floating, and it was floating off of SOFR. So from when we initially did that, it's floated down. I think it's floated down almost half a point. So when you're talking, between 17 and $20 million, that's a lot. So that's been helpful. But then I think this morning I looked at it, I think the 5 and the 10 were both up this morning, if I remember correctly, and it's been trending up. So, but current loan rates at agency, 5-year fixed, probably somewhere in 5 to 6.5. There was a point where we had a few term sheets that was coming in right under 5. Bridge and bank, we're seeing between 7 to 8.5. And again, this is what we're seeing. So deal size and conditions, stabilized or not, can definitely play a factor in this. Previous loan, we were seeing agency at 7+ and bridge at well over 9+, maybe higher than that at one point. So while it has helped definitely on our, for the impact it's making on acquisitions and refinancing, but I'd still say there's a few deals that, if we have the time to wait, my sentiment right now is to wait. If it's not a big cash out, redeploying capital, it's just hey, we just kind of taking current balance and refining it. And some of them are tough because you're going to pay fees, and if you're at 4% and you're going to refi, and even if we wait, we're probably still going to be at 5. So it's impacting cash flow no matter what we do. And so we're getting creative on some. What can we do to pull out the cash flow to offset that, and just different things like that. So supply and demand, like we mentioned earlier, new construction slowdown. We've seen that in most of the markets that we're looking at. We've seen some changes in the multifamily pipeline, and just kind of different demand drivers, all the things that we've been talking about in here. Where we see the opportunities, you know, periods where capital is becoming cautious often produces the best buying opportunities, which is very true. There's less competition, better pricing, more favorable finance structures, and seller flexibility. Even if we're getting terms, if that lender, the Grove is a great opportunity. I mean, we had multiple aggressive term sheets, and the lender followed up with us frequently. I mean, they wanted the deal. So I think that's the time we're in right now. The more that market opens up and the more deal flow, lenders, may not need much on their balance sheet. The more capital flows in, a lot of pieces are factored into that. So I think we're in a really great time to rates have gotten to a good point. I think, we're seeing slightly better. We're starting to see some opportunity, maybe not, the absolute best, but it's a good middle point because once things just, we get into that cycle, everything goes crazy busy again. And then everything will be more competitive. Cap rates will compress, pricing will go up. So that's what we're seeing there. What all this means for investors or potential investors, I mean, like I said, underwriting, very disciplined, matters more than ever right now, finding the right deal, especially with us entering new markets. With supply pressures normalizing in the markets we're looking at, I mean, again, that's a big deal. The less new units get built, the more opportunity we have to increase the ones that we're looking at or, purchasing. The refinancing pressure, again, rates are a little bit better, but if you got 3 or 4%, it's $20 million deal. There is no great option for that right now. So a lot of people are just looking to sell. Like I said, we have stuff in our portfolio that we're going to do that with. We'd rather just offboard it and redeploy that capital somewhere else. So, today's environment favors, patient capital and operational expertise. I believe that more than ever. I've always said we're not a fund model. We're deal by deal. If the right deal comes along, we will take advantage of it, bring that out to investors. And if it doesn't, we will continue to focus on our existing portfolio. So that's been our mindset, and will continue to be that. So we're looking at we're looking at new opportunities, but at the same time preserving capital, especially internally. Dry powder. As we're exiting some of our older deals, we have a lot of cash we're sitting on, so it's tough for us to. I've had some frustrated investor phone calls. They really want to deploy capital. They have capital with us. They want to put the additional there, and we're in the same boat. We've been creative, putting some of our stuff in, some short-term funds, or we've been doing some investment lending. We still have a single family division, that does a lot of wholesaling and pieces like that. And we're financing that through our financing arm, and just to keep our money moving, at a, whether it be, 10% or 11%, something like that. We'd rather deploy it into a bigger deal with more upside. And the more we're selling off our old portfolio, the bigger that problem's becoming. But so we're waiting on the same deal. So if anyone having that sentiment, like we have it too, we want to deploy it, but we're not going to do it till it's the right deal. If you want to get involved, you can join our investor list if you're not already on it. You schedule a call. If I haven't spoke with you before, property tours, we're trying to host those frequently. We always host them on a new acquisition. If we don't have a new acquisition after the one in August, we'll probably start hosting some on some of our existing assets. So, and then the webinars, we're trying to put these out there. And then, if you're on our list, I've been sending out monthly updates. They're kind of like a small summary of what we talked about today, and then trying to do this quarterly. So, and then we always appreciate the feedback. If you think the webinars are great, if there's more info you'd have liked to have had, you think our cadence is too often, not often enough, all the feedback, every single piece of our communication come from feedback. So, all right, we'll get to a Q&A. Do we have any questions in the box there, Clayton?
Nothing yet.
Okay, we'll give it a minute, see if, click that off there. So if anybody has any questions, y'all want to throw them in the Q&A here, we're happy to answer those. Let's see, nothing on there yet. We'll give it another few minutes. Like I said, we'll send this out as well. And if you think of a question later, I mean, feel free to shoot that over as well. Like I said, email, call, what have you. We'll probably get this emailed out. I don't know if it'll go out tomorrow, maybe first part of the week, but we'll get it out to everyone. So,
got 2 questions. Occupancy rate at the Grove, how many of the 288 units are rented?
So right now we're sitting a little over half of the units. That includes all downed units in construction. But we are at a point to where the past few weeks, we've finally seen that point of, because this is expected as the new leases start. You have to get the units ready, lease the new leases, but then we're evicting. But we're past, I would say, the bad apples there. So we're starting to see positive increase on that.
Yeah.
And we have tons of units coming online. So.
Okay. And then someone just asked if the slide deck was available. I don't know if that was before or after you mentioned it.
It will be. We will be sending. I won't say like don't send it out like particularly as an attachment, but this recording will go out. So.
That's it.
All right. Right on time here. All right. Well, again, thank you everyone for joining us. Reach out if you have any questions and talk to you soon.